In this Q&A, what leads price movement and why? Thanks for submitting the question, Jonathan. It's not the first time I've heard this one, so we'll wrap it up now. So first of all, bookmakers found this to be a very big problem when exchanges first sort of rose to the top. And I think over the longer term period of a number of years, this will be a very substantial problem for bookmakers, and I think also a lot of people expected it to happen even earlier. But excluding the side markets, I think the main markets will take over on the exchanges, and eventually bookmakers will become extinct in those kind of markets. So, you know, they'll be there for place markets and additional markets like that, you know, correct score markets and stuff like that possibly. However, the main markets eventually should, in theory, end up being dominated by exchanges, because exchanges lead the price movement, and they are the better proposition for everybody. So more importantly, how can this help you and your trading in the markets, and can you put it to any kind of use? So we'll have a little look at the different elements and why, and hopefully this explanation that I'm about to give you will allow you to make some slightly better decisions at points as well. So first of all, exchanges have to lead ahead of bookmakers because, you know, the overround is as close to 100% as possible. That's a fact. That's not my opinion. That is just a complete fact that exchanges lead in the sense of the overround's 100%, whereas a bookmaker applies their margin afterwards. Yes, there's a commission to be involved with that, but that's why exchanges lead. There are occasions where exchanges don't lead, but we'll talk about that in a moment. If you don't understand what I'm talking about when I say overround, I'll whack a link in the comments below. So for anybody that's interested in reading up on what the overround is, they can there. Now, this is also why bookies got skinned very early on in the early 2000s, and that was because they weren't ready for it. Because they were used to making their own books, changing the odds depending on supply and demand. However, that wasn't relative to supply and demand of the wider world, if you like, betting online. And so there was price imbalances at times, known as ARBs, you'll have seen in other clips, which allowed you to extract profit from the bookmaker because basically they'd got a price alteration different to the exchanges. So, but what I'm trying to say here is exchanges lead price movement and price activity within betting markets. There are exceptions which we'll talk about now. So when does a bookmaker's book lead the exchange pricing? It does happen, and it's often when there's very large liabilities with the bookmaker, which then, you know, find their way back onto the exchange. I'm not saying wholeheartedly the whole amount of liability finds its way back onto the exchange, but they need to hedge their books. If you think about it, at the end of the day, they take bets on different runners, and so they need to even up their position. And instead of hedging with each other, it just makes sense to have a hedging account with an exchange. I know a lot of them have got hedging accounts with Betdaq, and they dump liability there basically. So bookmakers are lagging to the exchange markets. Although if they have a very large liability, they will then dump money on the exchange, and so obviously they were leading in that instance. When can you see that? I think it's most common when you've got situations where maybe a jockey or a trainer or a jockey and trainer combination have had, say for example, 4 runners on a day. The first 3 have gone in, and then you've got Joe Public, everyone and his dog that have got trebles, accumulators, trixies, all that kind of stuff loaded up on that trainer combination. And so there's an extreme amount of liability because you think obviously the money rolls over from each leg of that accumulator. So on the 4th one, they need to hedge their position before the race starts. And in some instances, the very big events like Cheltenham, you may even find the big firms like Ladbrokes and etc. may be dumping liability as well. At the end of the day, they're all doing the same thing. In terms of smaller bookmakers on course, I know it always used to be possible to get a larger stake on course. I don't really know if that's possible anymore. And I know that they would be doing exactly the same. You think about it, they're exactly the same outfit, they're just a lot smaller. So if anybody needs to hedge their position, it's probably them more than anyone else. So you only need to look at places like the dogs, and you'll see the money filters on very late, very heavy. And you might have seen, if you watched the live show before that, or the show leading into the start there, that the bookmakers on course have taken some huge price drops. So what I'm talking about is basically fear exhibited through the bookmakers' prices, which then finds its way back onto the exchange. So in them instances, you may find a bookmaker leads the exchange, because I know there'll be some idiot in the comments going, oh, on this occasion the price was blah, blah, blah. But reality is exchanges lead, and occasionally bookmakers do, which is useful if you're looking to trade the markets, or even betting within the markets and you're thinking about betting on a particular selection. So you want the best possible price you can, but as infrequent as it may happen, it's probably good confirmation to your decision if you see that a bookmaker has gone from 7 to 1 to 5 to 1 without anything in between very quickly, and then a large amount of money pours onto the exchange. Because you think about it, I'll never advocate basing a whole trade on one reason unless it's something very extreme. But in this instance, you've got two there. So you've got the bookmakers, the arse has fallen out of the price, if you like, and then on top of that, there's money and traded volume filtering onto a runner, which has already been highlighted, if you like, by the bookmakers for you as for a specific reason. And again, if you add into the mix that maybe it's a fourth runner out of that's already had a previous winning treble, that makes perfect sense because it's even more. And so it can complement your decision making whilst trading. So if ever you see this and you were thinking that anyway, chances are it was a good call. And it's more likely to happen in these lower grade affairs, particularly stuff like on the all-weather in horse racing, or like I say, on the dogs, because there's very little resistance within the markets in terms of volume pushing back against those kind of gambles, because essentially it's gambles that cause them. But leading back to the first question, obviously exchanges lead. Occasionally, infrequently, there are opportunities when bookmakers lead, and that could help cement your trading decision.